Debt is one of those financial tools that can make very smart people feel even smarter, right up until it starts making decisions for them. And that is the part most successful people underestimate. Because when things are going well, debt can feel strategic. You use leverage to buy real estate. You use a line of credit to grow a business. You finance equipment. You carry a mortgage instead of tying up cash. You borrow at one rate and hope to earn more somewhere else. And in the right situation, folks, that can make a lot of sense. But here's the problem. Debt does not just affect your balance sheet. It affects your flexibility. And the more successful someone becomes, the easier it is to confuse borrowing capacity with financial strength. Those are not the same thing. Just because someone will lend you the money does not mean your financial plan should immediately start celebrating. Banks are very, very generous, right up until they're not. Let's start with why debt feels smart. Because in a lot of cases, it can be. Debt can help a business grow. It can help an owner preserve liquidity. It can also help acquire an asset. It can help expand operations. It can allow someone to avoid selling investments at the wrong time. So this is not one of those videos where I tell everyone to be scared of debt. Debt is a tool, but so is a chainsaw, if you know what I mean. Very useful, very efficient, just not something you want handled casually in flip-flops. The issue is not whether debt is good or bad. The issue is whether the debt is creating freedom or quietly reducing it. That's the better question. Because a lot of people think about debt only through the lens of interest rate. What's the rate? Is it fixed? Can I deduct the interest? Can I earn more somewhere else? Those questions matter, but they are not the whole picture. The cost of debt is not just the interest rate. It is the loss of optionality. When you owe money, someone else has a claim on your future cash flow. That does not mean the debt is wrong, but it does mean the debt gets a vote. And the more debt you carry, the louder that vote becomes. So instead of saying good debt versus bad debt, I think the better distinction is this: productive debt versus control debt. Productive debt is debt that supports a clearly defined strategy with manageable risk, strong liquidity, and a plan if things do not go perfectly. Control debt is different. Control debt is debt that starts narrowing your choices. You cannot invest because the payment is too high. You cannot take less income because debt service needs to be covered. You cannot sell an asset because the loan structure is complicated. You cannot handle a slow business quarter because liquidity is too thin. You cannot make calm decisions because debt pressure is in the room. That is when debt stops being a tool and starts becoming the boss. And this is where successful people can get caught. Because the debt may have made sense originally. The mortgage made sense, the business loan made sense, the real estate deal made sense, the line of credit made sense. But then guess what? Life changes. Rates change, business revenue changes, taxes change, family expenses change, markets change, and suddenly the debt that was supposed to create flexibility starts consuming it. The danger is not debt. The danger is debt without margin. Here is the uncomfortable part. Leverage usually feels safest right before it becomes the most dangerous. Because leverage is easiest to justify when things are going well. Income is high, asset values are up, the business is growing, credit is available, and everyone feels confident. That is usually when people borrow more. But debt is tested when conditions change. And when conditions change, multiple things can happen at once. Income may slow down, business distributions may become less predictable, investment accounts may be down, real estate may be harder to sell, taxes may still be due, debt payments still show up. Debt does not care that it was a bad month. Your lender does not usually send a note saying, hey, looks like you're going through a lot, let's just skip this payment. Lovely idea, not typically how loan services work. This is why leverage needs to be planned around stress, not just optimism. Because if everything has to go right, the plan is more fragile than it looks. Let's look at some visual framework. A stronger leverage plan asks, what happens if income drops by 20%? What happens if rates reset? What happens if the business has a slow quarter? What happens if a tenant leaves? What happens if an investment account is down at the same time cash is needed? Or what happens if we need liquidity quickly? Because leverage magnifies outcomes. That is why people like it. But it can magnify pressure too. Leverage can accelerate wealth, but it can also accelerate stress. This is where liquidity becomes extremely important. And I know, I get it. Cash is not exciting. Nobody goes to a dinner party and says, let me tell you about my emergency reserves. That person is probably not getting invited back. But when someone has leverage, liquidity is not lazy. Liquidity is negotiating power. Liquidity gives you the ability to wait, to make a calm decision, to avoid selling assets at the wrong time, to handle a slow period, to negotiate with confidence, to protect the family while the business works through a problem. The more leverage someone carries, the more valuable liquidity becomes. And this is one of the mistakes successful people make. They look at cash and say, this money could be earning more. Maybe, sure, but that is not the only job of cash. Some money is not there to maximize return. Some money is there to prevent bad decisions. That is a very different way to think about liquidity, especially for business owners, real estate investors, executives with concentrated income, or families with large fixed expenses, the Duffys. Because when leverage is high, cash flow matters, timing matters, access matters, and the ability to stay calm matters more than people like to admit it. So how should a successful person review leverage? Not emotionally, not fearfully, and not with a one-size-fits-all rule. You review it through a system. Question 1, what debt do we actually have? I want you to list everything. Mortgages, business loans, lines of credit, equipment loans, real estate debt, credit facilities, any obligations where the family or business is responsible. Question 2, what is fixed, what's variable, or maturing soon? The payment today is not the only issue. The question is what the payment could become. Question number 3, what cash flow supports the debt? Is it salary, business profit, rental income, portfolio withdrawals, distributions? The more uncertain the cash flow, the more conservative the liquidity should be. Question 4, what happens if the asset tied to the debt cannot be sold quickly? This matters with real estate, private business assets, illiquid investments, anything where the exit is not instant. Question 5, how much liquidity do we need to sleep well? This is not a spreadsheet-only question. That is a life question. Question 6, is the debt still serving the plan? This is the most important one, because debt that made sense 5 years ago may not fit the plan today. Your income may be different. Your family may be different. Your business may be different, and your goals may be different. Debt should not stay in your life just because it got there first. That is advice-led planning, not automatically paying everything off, not automatically borrowing more, not chasing the highest return. It is coordinating debt with the life you are actually trying to build. Debt is not automatically bad. Leverage is not automatically dangerous. But debt does change the way your financial life behaves, because debt gets a vote. It gets a vote in your cash flow. It gets a vote in your flexibility. It gets a vote in your risk tolerance. It gets a vote in your family's financial stress. So the goal is not to avoid leverage entirely, The goal is to make sure leverage serves the plan instead of slowly controlling it. If you want more conversations around business owner planning, investment strategy, tax planning, risk, and building wealth with intention, make sure to subscribe to the channel, and I'll see you soon.